Have you ever lost $22,000 in a day? I have. A great example is this recent fall in Supermicro. Do I sell as it fell 1/3, or do I hold? Stick around to discover the 4 skills every investor needs. But few talk about them. They are essential to handle losses like a pro without losing your stack. Losses are inevitable, even for the most seasoned traders. It's not about avoiding losses, it's about mastering how to handle them effectively and knowing what to do. Understanding and managing your reactions to losses improves your growth as an investor. Why is experiencing losses a normal part of the process of investing and trading? Because markets are naturally unpredictable. Even with a robust strategy, there will be occasions when the market does not behave as expected. Consider the example of SMCI, which plummeted in a single day. This drop was unforeseeable. Normally, SMCI provides revenue and earnings forecasts with its announcements, but it failed to do so this time. Investors took this omission as a bad sign and dumped the stock. No crystal ball could have predicted that. So what do? Sell or hold? Well, I will explain shortly once we get our emotions under control. It can really hurt when you lose a lot of money. When you're a beginning trader, but also when you're an experienced trader, but less so. As an experienced trader, a big loss feels like maybe someone cutting in front of you in the supermarket line. It's a mild annoyance, but you shrug it off and you move on. It's not a big deal. You have to see trading as a master game of statistics and emotion. If your account falls 5 weeks in a row, for example, you work out the chances of that and say, great, I just had a 2% experience. How did I get the 2%? Well, in my case, I know my systems win on average 55% of weeks, so that means they lose on average 45% of weeks. 45% to the power of 5 weeks, equals around 2%. And in my backtesting, that shows that's actually about right. Therefore, when it happens, if I lose, say, 5 times in a week, and it will happen, I think, great, I've just had a 2% experience, and the chance of that happening again soon is low. It might happen again soon, but it's very unlikely. So just accepting the odds and just knowing what the odds are of your trading systems and of investing in general will go a long way to kind of relaxing you when you have big losses and to see the bigger picture and not get too caught up in today's events or this week's events, for example. Now back to SMCI. If you have a look at this chart here, my exit with a simple system that I'm trading in this case is a cross of the 2 exponential moving averages. And now I know, if you're an experienced trader, you'll think, what a loser, it's a very simple system. And it is, it's the simplest system I've got. But for this basket of tech stocks I use it on, it's worked great for about 20 years. Now in this case, have the EMAs crossed? No, they haven't. So what do? I don't sell. So that brings us to the second rule of managing your emotions when you trade, is to follow your systems. Follow your systems exactly. But I hear you say, SMCI didn't come out with earnings guidance, so you should sell. Because you might think this is bad. Okay, but you don't know what the share price will do from here. It has already dropped substantially. If it was guaranteed to fall further, other smart traders would know that as well. And that would cause selling pressure, and the price would keep on going down. It would have already gone down, right? So as of today, given the information that we know today, and that everyone else already knows as well, can you predict the future? Well, the best you can do is follow your systems. You have to assume that your systems are the best you can develop, and if they're not, if you don't feel comfortable with them, then that's another topic, and we have to work on that. And I'll cover that in other videos. If we sell, we might miss out on a bounce up. If we sell, we might miss out on further losses, which would be good. We don't know unless we know our systems are wrong. And if we know our systems are wrong, we shouldn't be trading them in the first place. By the way, a great book about these topics, about trading and emotions, is Mark Douglas's Trading in the Zone. Great read, a link is in the description below. Now the third critical component to dealing with losses is to size appropriately. With backtesting software, you can test different sizes of trades. You can see the effect that different sizes have on performance based on past data. You can also randomize past data to get a more robust view. But if you don't use backtesting software, you can still size appropriately. The key for a more subjective approach is to look at very long-term charts and estimate, based on past price activity, what your largest loss is likely to be. You then choose a position size to make that loss, say, 1% of your total portfolio, maybe 2 to 3% if you can handle more volatility. Now, for example, if you think the largest loss is, say, 20%, the largest loss possible on a particular stock, well, not possible, but likely, is 20%, and you're happy to risk 2% of your account, then you would clearly invest 1/10 of your account, as 2% over 20% is 1/10. Your ability to risk more and handle more volatility will increase the more skilled you become at trading. You'll get used to movements in your accounts. If you take more risk than you can handle, you will exit trades too early. Then everything just falls apart. Occasionally there are circumstances which your backtesting wouldn't take into account. This is very rare though. I'm talking about situations which happen maybe once a decade or so, or once every 20 years even, such as September 11, 2001, unfortunately, or Iran firing 350 rockets and drones at Israel. That hasn't happened before. In such circumstances, there is one recommendation, and this is our third tip. Quote, sell down to the sleeping point. Unquote. Sell down to where you can sleep like a baby. You may say, but this goes against my systems. You just told me to follow my systems. Well, yeah, but not really, because the situations I'm referring to, as I mentioned, maybe happen every 10 or 20 years, and your systems weren't tested on them or designed for them. Bridgewater does the same thing. I think it's Bridgewater or Renaissance, pretty sure it was Bridgewater, who said that they follow their systems to the letter 98% of the time. So the mindset of accepting statistics, following your systems, sizing to what you can handle emotionally, and selling down to your sleeping point is what separates successful traders from the rest. I'm sure you want to be a successful trader, obviously. After preparing appropriately with systems and sizing, then staying disciplined and kind of zen-like is the key to staying in the game and maximizing your chances for exponential wealth. If you enjoyed this video, please subscribe so YouTube notifies you of future videos. And if you want to learn more, please join my Patreon channel. The link is in the description below. Thank you, and see you in the next video.